Welcome back to the channel, investors. We are currently witnessing one of the most pivotal moments in Bitcoin's recent history. As we speak, the king of cryptocurrency is locked in a fierce battle of consolidation, hovering precariously near the $89,000 mark. To the untrained eye, this might look like stability, but if you look at the broader picture, specifically the total crypto market capitalization, a different story begins to emerge, one of divergence, capital rotation, and potential volatility. The total market cap has declined from its recent euphoric peaks, shedding billions in valuation. Yet Bitcoin refuses to budge significantly lower. This decoupling is what we are here to discuss today. Is this the calm before the storm that propels us to $100,000? Or is the market running out of steam? Let's dive deep into the charts, the macroeconomics, and the on-chain data to find the truth. First, let's address the elephant in the room, the price action at 89,000. For several days now, Bitcoin has been trading in a tight range. In technical analysis, consolidation after a massive vertical rally, often called a bull flag or a pennant, is typically a continuation pattern. It signifies that buyers are absorbing the selling pressure from profit takers without allowing the price to collapse. The fact that Bitcoin is maintaining the $89,000 level suggests immense underlying strength. However, we cannot ignore the broader market context. While Bitcoin holds the line, the total cryptocurrency market capitalization has dropped. This indicates that liquidity is being sucked out of the system, or more specifically out of altcoins and speculative assets, and potentially flowing back into Bitcoin or exiting to stablecoins. This is a classic flight to safety within the crypto ecosystem. When fear begins to creep in, traders dump their riskier altcoin positions and retreat to the relative stability of Bitcoin. Now, let's talk about the institutional layer. We know that the spot ETFs have been a massive driver of this cycle. The demand from BlackRock, Fidelity, and others has created a floor price that simply didn't exist in previous cycles. Even as the market cap dips, we are not seeing massive outflows from these institutional vehicles. This tells us that the smart money is not panicking. They are likely viewing this consolidation near 89,000 as an accumulation zone. Remember, institutions do not buy tops, they buy ranges. They need liquidity to fill their order books, and a sideways market at these levels provides exactly that. If we were witnessing a true market reversal, we would expect to see heavy distribution, high-volume selling driving the price down rapidly. Instead, we are seeing declining volume on the pullback, which is a bullish signal. It means the sellers are exhausted. Let's shift gears to the technicals. On the daily time frame, the RSI is cooling off from overbought territory. This is healthy. You cannot sustain a parabolic run forever without resetting the indicators. The $89,000 level is acting as a pivot point. A daily close above 91,000 would likely trigger a gamma squeeze, forcing short sellers to cover and propelling us into price discovery mode. In conclusion, the consolidation at 89,000 is not a cause for alarm. It is a necessary pause for breath. The market cap decline is simply the market trimming the fat, removing the froth from speculative assets. As long as the institutional inflows remain steady, the path of least resistance remains up. We are watching a high-stakes game of chicken between the bulls and the bears, and right now, the bulls are holding the line. If $87,000 fails to hold as support on the daily close, we could see a rapid liquidation wick down to those lower levels to sweep leveraged longs. Conversely, for the bulls to regain control, Bitcoin needs to reclaim $88,800 swiftly and then attack the $91,000 resistance with high volume. The volume profile today suggests that while selling pressure is high, it is not yet capitulatory. Another massive factor influenced by the shutdown fears is the US dollar index, or DXY. Typically, when political instability hits the US, you might expect the dollar to weaken. However, in a global context, if the fear is high enough, capital rushes into the dollar as a global reserve currency, pushing the DXY up. A strengthening dollar is historically bearish for Bitcoin.